Good day, and welcome to the DoubleLine Diversified Fixed Income Webcast. Today's conference is being recorded. I would like to turn the conference over to Ron Riddell, President of DoubleLine. Please go ahead, sir.
Well, thank you, and good afternoon, and welcome to the DoubleLine Diversified Fixed Income Webcast with Jeff Sherman. The title of today's webcast, Bonds in the Year of the Rabbit. I want to highlight DoubleLine's thought leadership in the media. The Roundtable Prime is now up on doubleline.com. It's a three-part series, and it's featuring our financial thought leaders, Jim Bianco, Daniel DiMartino Booth, Jeffrey Gunlock, Charles Payne, and David Rosenberg. And it is moderated by our very own Jeffrey Sherman. Also, we have DoubleLine's Channel 11 and our two podcasts, the Sherman Show podcast and Monday Morning Minutes podcast. That's also available on doubleline.com and other mediums. So with that, I'm going to turn the webcast over to Mr. Jeff Sherman.
All right, Ron, and thanks everyone for joining in today. If you check out my background, it's a little different than you normally see. I am at the ETF Exchange Conference here in Miami today. So I'm on meeting number 11 today, and as you probably know with my energy levels, I'm so excited to talk macro with you guys today that let's start with that macroeconomic tour. I'm going to start with the macro, lead into kind of what we're seeing from the fixed income markets, review some of the metrics there, look at some relative valuation, and tell you how that leads into portfolio positioning. And then hopefully there's still enough time for questions at the end. So let's get this party started. So what I want to do is talk about the GDP situation. And we think about last year, we had a contraction in the first two quarters of 2022. And there was a significant debate on whether or not the U.S. was in a recession. We're currently in one. What's the definition of it? At the time, if you listen to our webcast, we were talking about that effectively the U.S. was not in a recession because of some of the other indicators we see there. But what I've done is update this chart from the long period from the post-World War II era. We get the GDP and the trend line. You can see that post-GFC, we've been below trend line. But what I had the team do this time was add actually the trend line since the GFC. And it's pretty amazing how we've just had this lower growth rate. So it's probably structural with some of the changes in the economy. But importantly, even with last year's roughly 2% annualized GDP on a real basis, it's roughly in line with the trend. The trend prior to the pandemic was about 2.3% per annum. And then obviously with some of the overshoots and the significant real GDP we got in 2021, we've kind of balanced that out here. So pretty amazing how the resiliency of the economy and what it looks like here. But again, the big question and the big overhang for the markets right now is where is GDP going? And so why I bring up the first half of 2022 is I think it's very interesting that we were having that debate. And there was really no economists out there, that at least Wall Street economists, that were forecasting recession. But then you fast forward the clock to really the end of the year, and you had roughly 60%, I'll say it again, 60% of economists forecasting some form of a recession and or contraction in GDP for 2023. And, there's an old adage we have around here at DoubleLine when everybody's in concert, usually that's not what's going to happen in the marketplace. And so I'd like to look at some of the economic indicators, and I'll give you the crib notes real quick that ultimately it's a mixed bag out there, but I'll go through that and show you what it looks like. And so one of the time series I like to look at to kind of measure GDP, and obviously, you only get GDP on a quarterly basis. And so you really can't measure the economic activity that frequently, but the New York Fed solved that problem by creating something called the Weekly Economic Index. And if you see, it's got a little more noise in it, obviously, because you have a more frequent periodicity. But interestingly, the directionality seems to be pretty good here. Again, we can lie with a lot of charts with overlays, but I find this relationship to hold pretty well. The problem is the economic index, it kind of forecasts year-over-year GDP, and so it really doesn't give you a good guide for the overall quarter. But what you find, or the forthcoming quarter, but what you find out there is that in estimates, whether you look at some of the street estimates or you look at something like GDPNow, you have something that's probably a sub 1% growth rate in the first quarter. But again, that's a positive number. I want to remind everyone that historically, at least in the last decade or so, first quarter GDP tends to be one of the weakest quarters. And some of that is the contention is that it's pulled through consumption in the fourth quarter with some of the holiday spending, and there's some of that hangover and paying those bills back as we move forward. So again, kind of says that, we're in this downtrend. No wonder it feels weak out there. Things are indeed slowing from where they are. But so far, the data has hung in there pretty well. And, if you think about how, the market has thought about the overall recessionary behavior, the overall behavior of the economy, there's something you can look at as the surprise index. And notice here what we have here. We have the U.S. is in red, the blue is the Eurozone, and the black line is China. And these three major kind of regions / economies in the world, everything is kind of surprising to the upside. Notice that huge uptick in the red line. It may not feel huge, but when you went from disappointing data to a surprise, I have to believe that's really driven by the non-farm payrolls and the ISM services data that we got on Friday. And I'll talk about that in just a second. But notice how well the Eurozone has done relative to expectations. And I think a lot of that has to do with just the negativity surrounding the energy crisis that we've seen in the Eurozone, but also the fact that it did not have a cold winter, at least to date. I will say I was with my European colleagues last week doing a road show out there, or 2 weeks ago, and it sure felt cold to a California boy. So happy here to be in Miami again, where it's more reasonable in terms of the temperature. But talking about the temperature, one way of thinking about the temperature of the economy is to break it in kind of the core pieces. And there's two kind of data series out there, two data providers that give you an update on the manufacturing and the non-manufacturing or the services part of the economy. And there is some conflicting signals between the two different providers, but I typically use the ISM because it has a longer history, and so it seems to give us a better signal for some of the behavior out there. Notice that since we've had the ISM data, you really only seen 3 recessions out there. But one thing that we hear a lot about is the U.S. is, we don't manufacture anything, but every time the manufacturing PMI goes below 50, which is signaling some contractionary behavior, everybody likes to drag out the chart on PMI here, the blue line, and say, look, we're going into recession. But notice all of the head fakes you've got from that blue line. And I was talking with one of our portfolio managers last week when this new data set came out, and we were trying to use the PMIs to kind of forecast recession. And what we talked about, and again, this is my contention, but he did some more analysis for me, was that you really don't need just manufacturing. You have to also have services go into that contractionary area to really signal recession. And here's what happened in the market about 4 weeks ago, is that we got a surprise to the downside in the services data. And so first of all, what I want you to know is how strong that services data was back in early 21 or mid 21 when we were getting all the stimulus from both the fiscal and the monetary side. People were out, economies open, spending money again. We had a big overshoot to the upside. And one thing that really, I think, rattled markets or rattled the rates market and caused a rally back in the first week of January was the ISM services data falling off a cliff. And it went from like a 55 handle down to, I believe it was 49.8 was the reading. And that really was a catalyst, I believe, to really set off the market in terms of a rate rally, thinking, oh, this is going to signal a recession. The Fed needs to slow down, potentially need to cut. We need to put on some recession risk into the portfolios in the marketplace. But notice the bounce back we got. We're back to 55.2. And so, again, we'll have to see, as my colleagues know, I like to say one data point doesn't make a trend. But what you can see here is that potentially that data print that we got from the December data in early January was actually an aberration. Why do I focus on this so much, and why do I care? Well, one, the market cares. If you notice, since this data point come out, the market has repriced the Fed, the terminal rate with the Fed. We've seen a really big move in 2-year Treasuries, for instance, as well, as the market's trying to say, wait a second, maybe there is more strength in this overall economy. I've talked to a lot of clients and prospects in the last 2 days, and what I hear from a lot of them too on this is saying, well, it's the jobs report. It's the jobs report that did it. Yes, the jobs report is strong, but I believe this ISM services was the catalyst for some of that sell-off, specifically in the front of the curve. So this is the good news, and this is really the chart to really hang your hat on if you want to think about the strength of the economy right now. This is the one data series I can really find out there that says we're going to be okay for the time being. And why I say that is that I want to start to look at some of the other indicators, and they're going to give you a complete opposite signal. All right, and these are leading economic indicators. The Conference Board reports this every month. They use 10 indicators. The red line is the year-over-year change, and the blue line happens to be the 6-month annualized rate. So why the 6 month? We're just trying to get a higher frequency type of signal to see if there's degradation in data. And the reason for doing that is we had such significant jump in those leading economic indicators back in 21. So if you'll notice the data set that I'm looking at, everything kind of suffers from this kind of overshoot or kind of abnormally high activity back in 21. And so not shockingly, we potentially will overshoot to the downside as well as we move along. And so taking a look here too, this is really a harbinger of negativity. If you look when the leading indicator goes negative, and obviously the 6 month goes negative first before the year-over-year does. What you find here is that this is kind of a condition where we've always had a recession over all of the sample size of 3 here when you have the degradation and the below zero parameter for the leading economic indicator. And so this is one of those that has a very good track record. Again, sample size is relatively small, but it is something that puts us on kind of that recessionary watch throughout the U.S. economy. And then another thing that is truly indeed unprecedented is actually the money supply growth. And in fact, we should call it money supply contraction. In the first time ever, the previous month, we got a year-over-year growth rate in the monetary base of 0. And you can see we flirted with that previously. We usually are printing money supply into the economy. But notice that we're getting a severe contraction. Some of this is from the overhang from the fiscal stimulus. Some of it is also just essentially kind of the Fed's balance sheet working through and having to resupply that marketplace and replace, those bonds get replaced with removing money from the system. And so this is typically not a very bullish signal when you get low M2 growth. And more importantly, you also don't see, we've never seen a contraction there. So this does not really portend well for economic activity, as there's not more money kind of sloshing around the system. And we overlay here the CPI chart. I'm not a big fan of putting this on here because you can't look at just money supply in a vacuum. You have to also look at velocity. But ultimately, this probably does put some pressure downward on inflation. And so you can see this relationship, it's kind of directionality more than anything. And again, the R squared here is going to be quite low, but the directionality and again, the economic theory says that should help drive inflation down. And another measure that we like to look at, because again, if you think about the way the BLS calculates inflation, there's something in there that economists call hedonic adjustments. And so they look at the quality of the product, and let's say you bought a car and the car is the same price year over year, but you have heated seats this time versus not before. Well, they would actually say that car is actually cheaper because you get more value out of it, and therefore the price of that should be lower. It should have been higher, and because it's flat, they actually make that adjustment. And so another way of looking at this is to actually look at the goods themselves, import and export. And you can see here on a year-over-year basis, the export prices and the import prices are starting to signal that we're going to see some form of slowdown in inflation. And we've already started to see some of the slowdown in inflation, and a lot of that has to do with the goods component, which I'll talk about in a minute. But definitely, there's another kind of thing I'm thinking about with the supply chains and just report on deliveries and how slow they are. But you can see here that now we're actually starting to see a significant improvement in the supply chain, and this is important too because if you think about that improvement, it should be more competitive. We can see that from import and export prices as well, and so ultimately this should help lead to continue to put this, as Jay Powell keeps saying. I know we counted more than 10 times I'm using the word last Wednesday. I was in meetings, but my colleagues tell me that he used it today, talking about disinflation in the economy. So we're starting to see that across the board, and things are slowing down. Also, a good sign here is that the prices paid indices that come from manufacturing are starting to show some relief as well. So where we had this high PPI, the input costs were leading it. It really was driving inflation. And so you're starting to see some improvement in the supply chains across really all the time series. So hopefully that leads to a lower level of inflation. And there's an interesting way of looking at CPI. And this is a chart I've used for many years now. And I used it for a different reason than I use it today. I used it to always show what the resilience of the housing market was and its contribution to overall inflation. And so there's a few things to observe here. One is, first of all, the black line is headline inflation. So this is the year-over-year inflation rate. This is what the market has been cheering really since the beginning let's say since the CPI report in October, when risk markets bottomed, rates kind of peaked out, at least on the back end of the curve. And we started to see kind of this rally in both risk assets as well as rates. And this is core inflation, so it strips out commodities. But you can think of inflation as having two principal components. There's goods and there's services. What I'm showing here is the contribution. So it's the weight in this index times the performance of the CPI rate within that goods sector or services sector, whatever it may be. And so one thing to notice here is that during recessions, goods tend to be deflationary. There's always periods that you have deflationary prices of goods. A lot of it stems from hedonic adjustments. But you do see that in the data. So goods inflation is really something we don't see very often. You saw it in the 90s. It dissipated with the recession in the 2000s early on. We didn't really see goods inflation until we got a recovery, right? So if you think about that post-GFC, when things started to recover, you got a little bit of activity. We had a big boom when kind of the housing market started to bottom again. And then we went back to deflation, or really just a zero-ish type of inflation rate of goods. But notice what happened. If you look at what happened, post-pandemic, not shockingly, the goods inflation's there. This data is starting to roll over. In fact, if you look at the goods component inside of CPI for the last 3 months, each of the 3 months has indeed been negative. So it looks like the supply chains in those few charts I was showing prior to this is really driving that headline inflation rate down. And so if we get to the level where we start to see goods deflation or just a zero rate, that just leaves us left with services. And now the challenge with core services is that if you see, even if goods went to zero today, we would still have a 5% inflation rate. And I was chatting with someone, an economist today, who was saying, Jay Powell is talking about this wonky thing, services, X housing or non-housing services, and he's just making stuff up. And I said, wait a second, this is a chart I've been using for many years, because notice how stable that area is of that yellow chart. And it may not look it because of the volatility of the other series. But notice a couple of things. One is it is relatively stable in its contribution to CPI. It gives you somewhere between 1.5% and right now we're getting about 2% inflation from it. But also notice that it does not go negative, or at least it has not went negative in the last 30 plus years. So this idea that Jay is focusing on this area, it's pretty interesting to me. One is that it tends to be a positive contributor, and I don't think it's that outlandish to what we're seeing from this side. Now, again, this is a hard part to control. It's education, it's healthcare, it's kind of like the dining out and eating parts of the components as well. So things that the hotels and leisure and the things we do to keep our economy going. So, expecting some magnificent improvement in here, I think is a pretty wishful story. Now, we all know the shelter component story. We've harped on it for a couple of years now. And you can just see that even with the rollover in housing, it hasn't even hit the CPI calculation yet. So this is expected to go down. This number should start to roll over in the next quarter or so. There's just a lot of operating lags in there, but we see it from house prices, we see it from rent rollovers, and you're starting to see some improvement there. So the good news is that inflation does seem to have peaked at this point. Secondly, you also seem to be moving in the right direction. And when you annualize core inflation for the last 6 months, it actually is running at a sub-3 rate. So ultimately, we are getting in the right direction here, but we still got a long ways to go, as the chairman himself said. So the improvement is widely expected in the marketplace. We got to a 9% inflation rate. The economists believe, we show this chart in almost every webcast too, that we're going to ultimately grind our way back down to the 2% target. The market totally believes that. It says we're going to get there. There's a weird little kink in that blue dotted line in the curve there. But ultimately, the market is the NJ we trust. And so this is part of the price of the bond market now, too, is that the bond market seems to be looking to that inflationary regime. And another way to observe that is to look at break-even inflation swaps. And so the break-even inflation spread is just simply taking the difference in rates that make you agnostic to owning chips versus nominal treasuries. And notice here that the market is really back to where it was in 2020, right? It's like it was all just a dream, this inflationary environment. And even notice during the peak, 5-year break evens only got to about 370, right? So the market is really in Jay We Trust, as I said. They believe the Fed's going to be able to control this thing. And then again, maybe what it is that the market thinks we're going to have a recession. There's going to be some deflation. Then we get the inflation back. It's hard to interpolate that from just a 5-year point. But if you look at short-term inflation rates, they kind of signal a similar type of tone. Yes, they did sit down. They did settle down on the front end of the curve to sub 2 at this point. But that also, these are headline inflation. They include commodities, so food and energy as well. Another thing that is very strong in the marketplace is the labor market. And the critics say, and we all know this as well, is that labor is a lagging indicator. It definitely has a lag. Companies don't just get rid of people because they think a recession's coming. They do it because they either have a bad business, they're way over their head in overhead, or they're admired in a recession. They see a slowdown and need to really cut costs. And so there continues to be improvement in the labor market from the unemployment side. Notice even this 12-month moving average is sub 4. That's not something you see very often. And again, this is one of the best unemployment numbers in like the last 50 years or so. But that said, too, I don't know how much farther we can squeeze this too. So ultimately, this is probably, at full employment at this stage. We did see labor participation pick up in the last in the last jobs report. So there was a lot of positives that came out of that report. JOLTS data, I love Mr. Powell. This is like one of his key dashboard metrics. And in the last press conference last week, he's like, oh, the JOLTS data, that's volatile, which is kind of amazing when we got to see an uptick in it. Again, this is where I believe this is the stress in the labor market, the openings versus the unemployed, or at least this is the imbalance that's referred to. And I think some of this imbalance really stems from the services sector. And you've seen this in the last few jobs report that the services side continues to be strong. And as I do my travels and look around, I still see an understaffed area when I go to services, when I go to hotels, when I go to the airport, when I go out to eat. You have these things where they're underserved. And so potentially this is the one thing that we can hang our hat on for the time being. So anyway, moving on. The other thing that if you think about wage growth, this is the other thing that's been improving. If you look at the red line, this is average hourly earnings. And I take pause with the average hourly earnings a little bit because it doesn't adjust for the composition of the jobs in the labor market. It takes average wages and compares them to average wages. So this is a good improvement. Some of this is because higher end jobs are the ones that have really been rescinded as of late, or you've seen some of the layoffs in the tech sector or even in financial services. But notice here that blue line, and this controls for the composition. Ask someone, what do you make this year? What did you make last year? And you see that still ran at 6%. So if the Fed wants to continue to hike, if the Fed wants to be more hawkish, this is the thing that they start to focus on. But I don't think that the Fed is going to focus on this. I think they're really trying to say, okay, we've done a lot. We're waiting for the lags to get through the system. And ultimately, this could be something that you could use to hang your hat to be much more hawkish on. But ultimately, I think you're starting to see improvement. I think Jay is welcome in the data series as well. We had the employment cost index. That's the thing that Chairman Powell references a lot. That's the green line to this chart. The difference in the employment cost index only comes out quarterly, right? So we don't get a lot of data on that, but you're seeing a big improvement there as well in this wage growth. And why I say it's an improvement is because, again, the Fed believes in the Phillips curve. They believe that wage growth and low unemployment drive inflation. And I think we can all see that there's a lot more going on than just wage growth that drove the last inflationary regime we have. And the consumer continues to consume. The savings rates were obviously massively elevated when you're on lockdown and you're getting money. We're still getting paid from our salaries and we have nothing to do except to sit at home. We're going to have high rate of savings. And so this is not the absolute level of savings. This is a savings as a percentage of disposable income. And so what you're finding here is that savings seems to maybe be ticking up. Maybe it did bottom a little bit here. But the health of the consumer is not as strong as it was let's say, in the post-GFC pre-pandemic era. And I think some of that was low asset returns, so people felt they need to save more. Maybe there's too much speculative risk taking and things, and so people need to use their savings to kind of, or they were saving less because they were actually spending more back into the economy. But again, this is not necessarily something that it's recessionary. It's not necessarily something that's positive, but I just find it very interesting in how much volatility there has been in the time series. And so the market really has been kind of whippy in terms of its expectations for the Fed funds rate. And if you rewind the clock back to mid-October, like I said, when we had the high end rates in like the 10s and 30s, we had kind of the low end risk assets, whether that's measured by wides and spreads or like equity prices. What you find is that the market had been fighting the Fed for the last 3 months. And so, as I said, the bond market was looking through the inflation data. They're looking at kind of month over month numbers and how they're running and saying, you know what, maybe the Fed isn't going to go as far as we thought they were going to go. The Fed has been telling you for really the last 3 or 4 months, they want to get to 5. Right? No matter which Fed governor you hear, you always hear something 5, except Chairman Powell won't admit 5. What's interesting now is that after that non-farm payrolls, and I would argue after the ISM service report, we're at like 512.5 today. So I looked it up right before I came on here, and that 512.5 is exactly the midpoint of where the Fed funds dot plots were in December. So the market's saying, well, maybe all of a sudden there is a little bit more strength out here. Maybe the Fed is indeed going to get there. And again, it's not a huge shift in pricing, but it's obviously impacted the front end of the curve. And so again, as I said, with the expectations, if you see that terminal rate, that little peak in the yellow dotted line, it coincides exactly with that dot from the dot plot. That's the median projection from the SEPs from December of last year. And so the market's saying, okay, Fed, maybe you're right. Maybe you're going to be able to engineer something, but at least you're going to be able to get to your targets. And I think it's pretty interesting too that typically when you see the Fed hike and the time they first do the cut, you usually see a rise in unemployment. And so we have not seen that whatsoever at this point. By the way, I don't think we're done with the last Fed hike. The market's got 2 more 25 basis point hikes priced in at March and the May meeting. And so we haven't even got to the end of this yet, but I thought it was pretty interesting to look how much the unemployment rate rises. And so you can see we took this from Gerard Manac. He's a good person out of Australia. He puts together a lot of great stuff. And we're a good client of his. But you can see where he calls it the soft landing. And that's when you have only a very small rise in the unemployment rate. And so we obviously know what the other ones look like. But it was pretty interesting to see that the Fed was forecasting for this year roughly a 1% increase in the unemployment rate. And why that was so important is that it's funny that people dismiss all the Fed forecasts, but it's like if they forecast unemployment rate rising, we should listen to that one. I mean, they're not really good with any of their forecasts in general, just like most of us. But that being said, what you see is a 1% increase is not a soft landing, right? That typically ripples through the marketplace and there's a lot of pain. So again, be careful what you wish for, Jay, and Fed governors. If you want to slow this thing down by increasing unemployment, you may end up overshooting to their side. And you can see here that we've had significant moves upward. Usually a recession is anything more than a 1% rise in unemployment. I just thought I'd bring back the balance sheet real quick. Something that doesn't really get talked about at the press conferences. Maybe someone from like Circus News or whatever that last person was. I can't remember exactly what the name of the organization. I think he did ask something about the QT at the last press conference. But you can see here that the Fed is on automatic pilot, right? I mean, they've been running at about $250 billion. I'm sorry, that's $250 billion, $250 billion a month, and they're not getting exactly their target. We all talk about it. Someone just messaged me and said it was Punch Bowl news, not the Circus News. So maybe punch bowls and circuses. I was thinking about partying. So thanks for that. My colleague out there. But what you see is that 250 billion has kind of been stable. If you look at that bottom chart, they can't get to the 95 billion because the mortgage book doesn't roll off enough. And by the way, if you look at their maturity schedule, they're going to start to have a problem of actually hitting the target of 60 billion a month in treasuries in really the next 5 months or so. And so there's ways to get around it. They can do a twist. They can buy some shorter dated paper, rotate a little bit of their book around so that they get that roll off. But I'd be curious to see what the Fed's thinking as they get into the next 6 months, assuming they can continue the QT. One thing I thought is interesting is there is the reserve balances, and this is what the Fed is saying to Treasury. So this is essentially what the Fed was making by owning the bonds and what they're sending to Treasury and paying back. And so you can see that they were a positive carry entity forever, and all of a sudden now there's this big drawdown. And what is the difference here? The big difference here is essentially the reverse repo facility. And since the Fed has a standing repo facility and they're paying an above market rate, or they're paying a market rate that's above the coupon on their treasuries, they're actually losing money every single month. And so I find this, and by the way, that break in the line when it went negative, it started doing cumulative versus just doing these weekly reports. So it's not as exaggerated as it looks. That said, I do find it pretty interesting here that even the Fed is feeling the pain of the inverted yield curve, right? This is exactly what you would expect, kind of running a portfolio, a levered portfolio, where your yield on your portfolio is lower than your borrowing cost. And so again, the Fed is a really bad hedge fund, if you want to think about it this way. It's like that very stable profile, did it well, won in the world of leverage by using leverage, and then all of a sudden, again, because of that borrowing cost and gets repo facility, it's driving it, bringing that down. So that's what I have for macro today. We all kind of see a lot of this. Just to summarize again, the highlights are the labor market still. We know that's a lagged indicator. The ISM services data is pretty strong because, again, that is something that drives our economy. The estimates of we're 70% or so service driven in this economy. So it's very important. And by the way, that's where the bulk of the jobs sit. So tech jobs, finance jobs, even though they're more high paying, there's not as many of those driving the economy. And that's what's been driving a lot of the headlines out there. So my comments on the macro is that it's a conflicting data set because the powerful indicators are still there, but so many things we've relied on in the past to signal a recession are indeed flashing warning signs. So I think it's prudent to stay cautious when thinking about your allocation. Enjoy the risk rally you've had, enjoy some of the rate rally you've had here, but I think you need to be playing for multiple outcomes. And so as you're all aware, at DoubleLine, we don't like to take unidirectional bets. We don't want to just have a univariate forecast. We want to have something that can hopefully be balanced in terms of its view. And so just to rehash last year, our weekly marketing calls that we have, our marketing folks can we just stop looking at 2022? So even the sales folks are jaded by 2022. But, it was obviously the most painful year out there. But if you're an equity investor, it wasn't the worst you've seen out there. But if you put it together in the 60-40 and the S&P return is on the horizontal axis, this is really horribly formatted. The data point should be low. But if you look at the S&P returns on the horizontal axis, the vertical axis is the Bloomberg Ag, you can see this is hands down the worst quadrant to ever be in. Right, 1994 was thought of as the horrible case in fixed income because you had both negative returns in both the stock market and the bond market. But 2022 said, "Hold my beer," as the kids say these days. And what's really amazing is the amount of drawdown in the 30-year Treasury, and this goes back to '87. It's just the time series that we're able to use. I've seen other data sets from a guy, Jim Bianco, who uses UK data. We have Treasury data back in the 1870s. And what you find is that it was the worst drawdown from peak to trough that we've seen in the long bond ever. So the pain was real. It was across the board. But notice that bounce back. And I think what's important here and think about the bounce back is that, the thing about bonds is that they do mature at par if there's no default. And so when you think about mean reversion in the fixed income marketplace, mean reversion can be a powerful force. And so even though the current drawdown was 42%, it's coming off of minus 50, right? And the math is not that's just an 8% rate of return, right? To get there, that's like a 15% rate of return. And so it's why I point that out is that you could easily see some of these bonds claw back their performance, especially if we had something like an economic downturn. And the credit markets also stunk last year. Don't have to remind everyone about it. The highest quality bonds were the worst hit. You look at the Treasuries, you look at the high-end part of the investment grade curve. And also, if you look at long bonds, they did worse. The AAA credit seems to be a little bit longer duration, but really floating rate were the only things that really helped you. The CLO market at the top end of the cap stack was a positive contributor, and so were double B loans. And you can see there the leveraged loan market did relatively well. You can see CMBS was a decent performer as well, decent when you look at the sea of red. And so I think it's very important to look at this to realize that what pain was out there, but pain does create opportunity. And if you take a look at what's happened year to date now, what you can see is that there's been a massive reversal in some of these assets that were beaten up. And so the stuff that was on the right-hand side of some of the worst performers tend to be on the left-hand side now as some of the best performers. So notice this too, triple C high yield, single B high yield, the AAA investment grade, again, that was the duration trade. The CLO market has reversed all of its losses from last year in the double B tranches. And so you can see as you go through here, it's been pretty easy to make money in fixed income in the first 5 weeks of the year. And so ultimately, what we're seeing is signs of the lower quality stuff rallying. It was hit the most. And so we're using that as a way to sell into a little bit of strength in some of those assets too. And the reason for doing so is just to be a little more prudent. As I said, our economic indicators are telling us to be on recession watch. And so we need to really think about the credit that we own. But as I'll show you at the end, the credit is very, the credit still has very attractive attributes. Here's the rates trade, dollar and rates. We've been the same trade. That's what I'm pointing out here. Really not much more to say here, but the weakness we've seen in the dollar has really been attributed to the rates peaking here in the U.S. I'm just using the 10-year to illustrate that when our carry was significantly better than the rest of the world, you had this gravitation to the dollar, and you've had a reversal since that point in time. Good news is we're still the carry trade. That is what I mean by that is that we out yield the rest of the world in the developed world practically. I think we're tied with gilts these days. But effectively, as you think about this too, you have policy rates that need to catch up to the Feds, right? So the ECB, the BOE, we've seen more aggressive hikes on that side, and that's done something here as well to the weakness in the dollar. But notice the dollar did spike over the last couple of trading sessions as we've had a repricing of the rates curve following the ISM data. And our good friend copper gold, we always like to talk about this. It's been pretty amazing with the copper prices. One thing about copper at this point, you've had a pretty significant rally. You've given some back as of late, but that significant rally, a lot of people think it's China's reopening. It's really related to a lot of the Peruvian mines. The Peruvian mine shutdowns we've seen, you see that by silver and copper, the ones that rallied pretty meaningfully. So I don't attribute this as, we should be calling Dr. Copper to see what his assessment is of the health of the economy right now. I think there's a little bit of a distortion. You can see that run up in that orange line at the very bottom. It has rolled over a little bit. But in general, too, copper gold is saying that the rates market is still too high. It's saying it's about 75 basis points or so too high. And, you have seen this new affinity for gold as well. Notice that gold prices rally. That's really what's driving a lot of this relationship over the past 6 months is that you've had a pretty strong rally in the gold sector. And that's a lot of that's attributed to this cool down in inflation as well. So what do rates look like, over the last, 15 years or so? You can see here that we didn't set new highs in any part of the curve. Sure felt like it with the pain that we saw in the market last year. But again, this is like old school type of yields. If you listen to our webcast from about 3 months ago, when we were mired in that pain in October, we were talking about how cheap the bond market was. How cheap it looked, everything. That's the rate side of the equation. It was credit. And we've had a pretty good rally there. So as I've told investors this week, you did miss it. You missed the rally. You missed the rally in January. It was fun. It was a risk rally. It was a rate rally. We were making money. There's inflows coming in the industry. Everybody's feeling good. But the problem with it is that, now what do you do now? And the good news is with the repricing of the rates market the last couple of days, I think investors still have an opportunity to be able to step into building a fixed income portfolio that can probably throw off another 5, 6, 7% throughout the remainder of the year. There's going to be some noise along the way. You're going to need to be tactical. You're going to need to move it around a little bit. But again, I think that the bond market is set up for some of the best cheapness we've seen. Not as cheap as it was in October of last year, but still the level out there that you can buy things to. And again, these things have the potential to rally as well. So people ask me, well, do you prefer the 2s over the 5s or the 10s or the 30s? I prefer the 10s and the 30s. And that's because they allow us to build a portfolio. If we own this kind of back into the curve, it allows us to build a credit portfolio that if indeed we start to see more economic weakness, we see the signs of the recession coming, we do believe that the 10-year and 30-year part of the curve can make meaningful money. And in fact, it'll probably outperform any degradation you see in the credit markets. And so when we get to the portfolios, you're going to see some of our positioning, and that's what we've been doing. And so the steepness of the inversion, people talk about the historic steepness of the curve. Well, it's not really historic, but it is a pretty meaningful inversion. This is likely to continue to invert more unless with the next couple of Fed hikes, you bring the 10-year with you. But again, this is signaling something to the market. This is a good indicator of a recession's coming. Usually you see usually the curve steepens back out before the recession is declared. So that's usually when you want to really, really be on watch at that point in time. But I think what this is definitely signaling is the bond market says the Fed is too tight. The Fed is too tight with its policy relative to the expectations of the market of inflation and the growth rate out there. And so, again, I'm not dismissing this. I saw one of the guys who's attributed of being the godfather of this metric. It's Cam Harvey from the Fuqua School at Duke. He was saying, well, maybe everybody knows this, and so it doesn't work this time. I'll say, let's wait till we see a steepening. If we can survive that, then I'll believe he can. But this time is different. It doesn't work a lot of times in markets. And so I said there's an opportunity set out here. One way we put this together was looking at where the yield was at the beginning of last year and where the yield is today in these various markets. And notice that you had a market repricing, right? If you look at the gaps from those dots to the bars where they are today, the increase is anywhere between 200 to ultimately as much as 400 basis points across the curve. And so I hear about, credit portfolios, and, I've been complaining about the high yield spreads getting too tight. I thought they were very tight when we got to 400. That's why the teams, we've been kind of trimming some of that risk in the portfolio. But notice that you get paid in stuff that is in the credit sector, right? I mean, non-agency CMBS, AAAs still yield 5%. Look at triple Bs, they yield 10.5%. They have risk in them, but you're getting paid for some of that. And so I kind of like that investment grade risk over, owning something like in the single B sector. It outstrips it. Yes, it has no liquidity. It has a premium or a less liquid premium. It has, headline risk, obviously, with the retail and the office sectors. But if you have a strong team like we do at DoubleLine and can do the underwriting, there definitely is an opportunity set in credit. And by the way, this has recession risk in it, but it's also priced for it. Notice the spreads there are significantly greater. The paper is shorter than roughly the high yield markets, or it's on par with it in terms of its tenor. And therefore, you do have this extra kind of yield in the market. So there still are parts of the market that are signaling some stress out there. And we think that investors who are prudent and know how to manage this should be able to step in. If you don't, we have some funds that are taking advantage of this today. And so another thing is just looking at the interest rate risk component. Floating rate was your friend last year. I'm not convinced it's going to be as helpful to you this year. Maybe the high quality CLOs look pretty attractive in today's market because, again, they probably don't have significant default risk with inside of them, at least at the AAA tranche. Maybe the triple Bs do. They're going to have a lot more price volatility. But notice, too, that all these sectors that we've highlighted here, the things that have lower kind of interest rate risk are off index. And so, again, you have to do the underwriting. You have to think about where you want to be for this point in the cycle. But there's a reason that we still like to own credit today. And even though our antenna is elevated, we're kind of calling a coin flip whether or not we go into recession or not this year. So I think you still want to own credit. You want to be migrating up the curve in terms of the quality and the underlying quality of the corporates or the credit you're taking. But ultimately, we think that there is still some opportunity here because, by the way, the price of some of these sectors of these bonds, they're in the high 70s or low 80s. And as I said before, the good news about bonds is that if they don't default, they pay you par back at maturity. And so that's a beautiful thing about it. You can expect, if you have good underwriting, you can ding for some defaults, you can still get a very significant yield in the marketplace. So we think it's prudent to do some of this today. But what allows us to really get comfortable with that is owning some of the things in the gray box, the things like agency mortgages, U.S. Treasuries. We're going to be a little longer duration in both of those assets in the market because we own this credit. So again, I think this is kind of old school bond management. I've been teaching people about bond prices again. because price does matter. I know we all trade on yields and think about that, but you have this thing called positive credit convexity in some of the sectors of the market today. Again, you have to be rigorous in your analysis. You can't just be Pollyannish. You've got to ding up the sectors as well. So let me talk about the valuation real quick. Looking across the various segments of the market, some just charts that we use as a context for thinking about risk premia. You can see IG corporates almost made it back to fair value, or just kind of average value, I should say, not fair. But we did get this big rally as of late. We've seen pretty good spread compression in the first month. It wasn't as much as we saw kind of in that let's call it November, December area, but you're still seeing it grind along. Duration does help you a little bit. It's a little bit longer asset. You can see agency mortgages still screen cheap. We've been a buyer of them. With some of the selling we did in some of the credit sectors, we put money to work in the agency MBS market as well as in the Treasury market as well. So again, the thesis there is continuing to build quality, own some risk down the spectrum where you're actually getting paid for that. The non-agency market is grinding along. CMBS, for as much headline risk and everybody talks about out there, notice that's kind of its half standard deviation rich relative to long-term trend, which it tends to hover around as well. So for all that pain there is something interesting about it. ABS are kind of fair. Oh, high yield corporates. Why did Jeff Sherman tell me that we're selling high yield corporates? Look at the valuation here. We're approaching the 2 standard deviation mark, something we don't see very often. And again, given the macroeconomic landscape, seems a little aggressive to us in terms of pricing. Again, don't hate that asset class. Not really concerned with significant defaults. But again, we want to upgrade the quality of the portfolio because in general, we don't think you're getting paid for some of that risk. Same thing with bank loans. We've been a net seller of bank loans as well. Again, I think the floating rate component, although your friend last year, not as helpful to you this year unless you believe in the Powell pivot. And Powell says he's not pivoting. The market doesn't want to listen. I think some people are betting on that extreme, but you can see there that the bank loan markets are screaming pretty rich too. Tips. Kind of come back to earth here. They got very rich. You can see why we like to look at these signals. A lot of times when you get to that 2 standard deviation point, it's a good time to lighten up. I'm happy to say we don't own tips in the portfolio today as they've been an underperformer relative to nominals. Munis, super rich. I'd say rich for a reason. I think every time I feel like I read anything about California, the taxes are going up. Cal Munis look pretty rich to me as well as looking at my own personal account and saying, why do I own some of this? I'm moving it to money market, that having the low risk positions there. So munis are screaming rich. They've gotten extremely rich, as you see here. EM still super cheap at the bottom. It's even after this rally. Our team is being more cautious with EM. Just again, given that we're kind of elevated in some of this recession watch. There's this newfound euphoria about the China reopening trade. And so again, we're not really reducing meaningfully here. At the margin, we've trimmed a little bit of our emerging market exposure in kind of the core-ish mandates and the core plus mandates. But again, it's not something that we're trying to wholesale or we're doubling down at this point. It's nice to see the improvement. The spreads do look indeed a little bit tight. And we're actually getting conflicting signals from EM that we saw in the other markets where you actually have really, it was only the high quality stuff that was working instead of the low quality. So with that, I'm going to go over to questions. I'm going to let my colleagues go ahead and give you the compliance tour and all the disclosures while I go into the questions. So how long will rates stay at 4% on the short end and the long end rise? And will the long end rise higher? I think the rates stay at 4% on the short end for the rest of the year. The Fed is telling you they're going to hike. They're going to continue to press the short end of the curve up. And they're likely not to cut. The Fed put is something that is not in play right now. They're not even talking about it. I like how Jay references his own quirky mannerisms there. So that's kind of shows some humility, and he is indeed a person. But the long end, I'm kind of conflicted on. I feel like the long end with 10s and 30s, maybe they push a little bit higher. We've been in this range for a while. It feels like we're going to stay in this range in the near term. And I think what the back end of the curve is signaling, I don't know if it's signaling a recession. I don't want to dismiss that. But I think what it's signaling is that the inflation environment, the inflation scare we have is behind us. And maybe Fed policy is too tight. That's why the curve is so inverted. But ultimately, I don't see the long end going significantly higher. So I do think it has the ability to go lower. But I think you need to see really some economic downturn and some malaise in the market. Someone is yelling at me in all caps. It says, with munis never down 2 years in a row, what are your thoughts on closed-end munis? They grossly underperformed. That's called, to go back and look at the Fed's balance sheet, their negative remittances we talk about. Cost of leverage is going up. SOFR is going to 5, probably, if not higher. You pay SOFR plus on that. That means you got a 6 kind of borrowing rate or higher, depending on how you're structured. And so, yeah, not shockingly, that had to reprice. So munis look rich right now. So levering a rich trade isn't my favorite. As I said too, from a California perspective, in my own personal account, I just sold my Cal money market funds that invest in very short duration. I use it as a proxy for cash there, and I wouldn't put it in a government money market account because the yield is significantly better. I get pickup there even after paying federal taxes. I still have to pay state either way. So I think they look rich by a lot of metrics. And I don't like the whole never down 2 years in a row. People said about the bond market. By the way, the bond market was down 2 years in a row. I don't think we get 3 there, but munis are not something that I will advocate at this point, at least from a California perspective. Comment on the MOVE index and the 10s-2 spread, how it may be heading is contrary. Well, the MOVE index started to settle down until the last couple of trading days. And I think it's been settling down because there's been a clear slowdown in rate in the rate path of hikes from the Fed, but also, we've had much more stability in the economic data, specifically the inflation data. So the MOVE index, I'm not sure that it really should drive the 10s-2 spread, but the MOVE index is what is the equivalent of the VIX in the bond market. It measures volatility, and that volatility makes it really it bleeds into credit spreads as well. So instead of looking at 10s-2s with moves, what I would look at is different parts of the kind of credit stack or the different parts of the credit ratings of the curve and look at that. So that's what I would recommend on that side. If the curve reverses, its inversion economy has strengthened. Typically, no. Usually when the curve reverses inversion, that usually means that the front end is coming down and we are in the recession. So, or we're about to be in one. So the reversing the inversion, people think that's a strengthening. But again, we are still inverted. So, going from -90 inverted to -80, is that an improvement or something? No, I'm going to call that a push. But if we get back to where we have a flat curve, let's say 2s, 10s or 3 months 10s, ultimately, I do think that is something that probably should put you on alert. Again, you have to be in the moment. You can't just look at these signals in a vacuum. So I think what the market is signaling is definitely the Fed is too tight, but I think that's going to be persistent throughout the year. Do you see a pending liquidity problem for the Treasury market? This is probably related to the budget deficit. Liquidity's been okay in the markets. It got really bad in March of 2020, even in the Treasury market. I know they've been talking about introducing new primary dealers and things, letting banks take down the Treasuries to help out as well. That is the intention of QT, by the way. The whole point is to slow this thing down. It's to really cause a little bit more pain out there. And that's what Jay Powell was. He was Jay Pain, right, for a while. So thanks for that question. Thoughts on emerging market debt? Like I said, it looks okay. There's been a big resurgence there. It says dollar versus local. Definitely like dollar, the hard currency, better than local at this point. But we've been trimming it at the margin, and we're pretty light in terms of EM. So we're not really pounding the table for it. It's done quite well. Our emerging market fund has been a very strong performer last year, and so I would say that again, I feel like it could be a sideways from here in terms of rates and vol. If that's the case, then EM probably does okay. But at this stage, there's other parts of the credit market that we think offer a better risk-adjusted return. Japan, yen changes with Kuroda retiring, carry, Japanese bank. That's a lot. So yen, if you want to play in Japan, I would either play yen outright, avoiding the JGBs, because we saw what can happen there as they manage their yield curve control. And if you want to still make that bet a different way, maybe Japanese equities. To not really thinking about the banks there. The carry, yeah, if you convert back, you can increase the juice there. But I think if you're going to do it, just own outright yen. That's the risk off trade. if you want to be a risk seeker with that yen trade, I would do it in the equity market. So thank you for that question. Someone says, if there's an 83% likelihood of a March hike and rates are expected to remain high and then come down, do you avoid floating rate? First of all, there is more than an 83% likelihood of a March hike. In fact, the market's repriced in the last couple of days. So there is a pretty much guarantee of a hike according to the bond market at this point. If they're going to come really high and come down, do you avoid floating rate? I don't avoid all floating rate. What I worry about is the ones that are marginally attached companies that, they're lowly rated and float, and they weren't able to access the high yield market. So that's the lower quality bank loans that I would be avoiding. But I don't mind floating rate, like floating rate CLOs. The AAAs look extremely attractive. Our CLO PM has been pounding the table of how cheap that part of the curve is, or that part of the market is. And you kind of have the basis, even if loans are weak, again, you have the subordination, the structure that can help you as well. So I don't hate all floating rate loans. I'm concerned with the ones that have higher coupons and do that. And by the way, when you talk about rates are expected to come down, that's just pricing in a market. And so the market pricing, especially as you go out the curve, is not a mean type of trade. It's not saying this is on average what's going to happen. It's a betting machine. And so if you say you have a 35 basis point cut priced in between the terminal rate, and that's May and end of the year, it doesn't mean that on average they're going to cut 35 basis points. It's probably, there's a 10% probability to cut 350 basis points because we're in a significant recession. So remember, traders trade, it's a convexity trade. Someone's trying to have a huge payout on that trade. And I think that's what's putting some of the pressure there. Also, maybe the Fed does cut a little bit. And they talked about in their minutes, I think it was 4 or 5 meetings ago, they did talk about they don't need to see inflation be exactly 2 to start to get closer back to neutral. And so that closer back to neutral, Jay said that, they're around neutral when they were about 2.5. So I think some of that is in the psyche out there as well. But I think it's more of a kind of tail risk or a high convexity trade. This says, in contrast to the last year or so, do you expect the dollar to decouple from the Treasury rates in a recession? In a recession or leading in? It's a good question. I think going into the recession, I think there's a flight to quality. People are bid Treasury, you bid dollar, you get dollar strength. Look at kind of what you would see in kind of traditional recession. However, when you get in it and the fiscal response happens, rates get cut, especially the rest of the world doesn't cut as much, that means declining dollar as well. So I think it's a tale of entering the recession versus being in it. And the bad news a lot of times is that outside of some of these yield curve signals and things, you don't know you're in the recession until the other side. Question here is, do you think high yield spreads remaining compressed is being affected based on many of those bonds in the credit space trading significantly under par? No. And that's the short answer. The more thoughtful answer is that I think that spreads are tight because one, corporate America did a significant amount of refinancing in 20 and 21, including the below investment grade space. And so it's a better quality trade than it has been, but also I think it's tight because of money flow. I think some of the quick trading, the fast trading you see, it gets put on through the ETF market. And so if you look at fund flows into HYG, J&K, LQD, kind of those credit proxies, you saw significant flow driving that price performance. So I don't think it's a significantly under par component. I know we did spend some time talking about bond prices today, but I think it's more of the fund flow driven and people saying that maybe we're going to get through this. Actually, moving to longer duration treasuries, no, that's not what we're doing. We're buying twos. We're buying front of the curve. We're kind of just running it as a more cash proxy, just kind of a short move there. And we're waiting to see kind of what develops for there. So thanks for that. Someone said, thanks for the answer. And I typed in small caps this time. That's awesome. So I love the real-time chatting. I feel like I'm on like Twitter or something here. Is there any concern the recent jobs report could be misleading? Always. People point the differences between the establishment survey, which is called non-farm payrolls, and the household surveys. They have been disconnected for many months. Two, there is some seasonal adjustments in there. There's ways of looking at it. But another way of kind of rationalizing everything is to look at unemployment claims. If you look at those, it's a different time series. It's reported by states. It's a lot different than kind of non-farm or the establishment survey. And so when I see it in the labor market right now, it doesn't seem to be weakening at all. So I know that's the bearish case, is that there's something wrong with the data. But again, it's hard to see that until maybe after the point. And that is the last question. Actually, someone said, thank you. You and the entire DoubleLine team are great. Thanks for this webinar. I appreciate you. Thanks for the comments. Thanks everyone to listening today. Hopefully you found it insightful. Hopefully it gives you some insight to positioning, and enjoy the year of the rabbit. Enjoy the year of bonds. I think it's going to be continuing to be a relatively good year. Don't extrapolate January's performance and annualize it. I don't think we're going to end up about 50% for the year. But I think there's the potential to really outstrip inflation this year. There's a chance to generate a real return. And I think there's the ability to generate a meaningful amount of alpha in today's market. So again, thanks everyone for tuning in. You can catch us on all of our media out there, my podcast, Sherman Show podcast, Monday Morning Minutes. If you want up-to-the-date macro, some portfolio managers, Jeff Mayberry and Sam Lau on my team, they cover macro every single week to keep you updated. They try to do quick and thoughtful in there. It's a good one as well. And we also have Channel 11 from our non-agency RMBS portfolio manager, Ken Chinoda. So check all that out if you're looking for more content. As you saw the website at the beginning. And also, just if you ever need anything, we're happy to get back to you. So again, thanks everyone. Thanks for your support of DoubleLine. We look forward to 2023 being a significantly better year than 2022. We start off on a good foot, and let's keep the momentum going. So best of luck out there, and we'll talk soon. Bye for now.